Hello ITS Board of Directors, my name is Grant Schuette and I'm a junior finance major here at Georgia State University.
My name is Andres Cruz and I'm a senior finance major at Georgia State University.
My name is Dick Masters and I'm also a senior finance major.
I'm Robert Anderson, I'm a junior finance major at Georgia State, and we'd like to thank you for taking the time to view our presentation.
Per your request, we have conducted a valuation analysis of the enterprise value of ITS as of the valuation date December 31st, 2011. Our purpose of this valuation was to conduct a fair market opinion of the non-marketable controlling ownership interest basis.
In our approach, we use the fair market value method, which means the subject interest would change hands from a willing seller to a willing buyer, both parties having access to reasonable, full facts, and neither operating under any compulsion. We also assumed that the company is operating under going concern, meaning that it will continue to be profitable into the foreseeable future. The company ITS was founded in 2001 in Coconut Grove, Florida, and has since expanded to 16 offices nationwide, operating out of a number of metro areas. Their revenue in 2011 was $203.3 million, and they have built a scalable business model which has enabled them to continue to grow.
To have a successful analysis, we relied on economic data and comparable industry data.
We also relied on the income method and the market-based method approach to come to a fair market value.
We used a weighted approach in order to come up with a final number where we weighted a discounted cash flow analysis, a comparable company analysis, and a comparable transaction analysis, where we used 70% and 50% and 50% respectively. And in the end, after this analysis, we have come up with the figure for non-marketable controlling ownership interest basis as $314 million.
When doing a valuation analysis of a firm, especially under going concern scenarios, it is very important to analyze the economic situation. The motive behind this reasoning is that businesses and assets in general are correlated to economic factors such as inflation, unemployment rate, and economic growth. Additionally, a forecast analysis of the economy serves as a guide for investors that are interested in the asset or business being valued. In 2011, we see a stagnant 1.6% RGDP growth. This is mainly due to uncertainty businesses perceived. Even though the economy was experiencing recovery, many firms were being conservative about how they invest their money. Politics play a very important role in the performance of our companies as well. In 2011, disagreement between Congress and the executive branch of government slowed down monetary and fiscal policy implementation. The inefficiencies were so evident that government was on the verge of shutting down. Besides politics and economic growth, another important factor to consider is unemployment rate. Naturally, unemployment rate is negatively correlated with business activities. The staffing industry, nonetheless, is way more susceptible to unemployment than the average industry. In an environment where businesses are being more cautious in the recruitment process, it becomes less attractive for these to link their hiring process with a recruitment or staffing firm. Technology plays a significant role in the staffing industry as well. Strong staffing firms like ITS are equipped with plenty of data to provide better services for their clients. And even though costs have been reduced thanks to technology, margins have been reduced as well. This is because total revenue has decreased. And total revenue has decreased because other businesses are starting to create their own training and recruitment platforms instead of going to an external recruitment platform like ITS will be. Now let's look at some graphs to have a visual idea of how the economic situation was in 2011. First, let's look at annual GDP growth. At the beginning of 2011, we can see a downward slope onto the third quarter, and then we see a slight increase in the fourth quarter. This is mainly because the fourth quarter is characterized by a higher consumer spending. Then, by comparing GDP from manufacturing and GDP from private services, we concluded that GDP from private services is 5 times larger than GDP from manufacturing. Looking at this graph of GDP from private services, we can see that total GDP equaled $10.5 billion. In contrast, looking at this graph, which shows GDP from manufacturing, we can see that total GDP from manufacturing equaled less than $2,000 billion, which is 5 times smaller than the previously mentioned GDP from private services. Now looking at interest rates, we can see that they remain static at 0.25% over the period being analyzed, and this actually infers a cheaper cost of borrowing money and making investments of it. Lastly, looking at unemployment rate, we see that in this graph that we're analyzing between 2009 and the end of 2011, and we see an 8.5% in 2011, which is the lowest unemployment rate over the analyzed period. After going over the economic situation in 2011 and analyzing external economic factors that influence in our company, we conclude that the future is bright for ITS and that high growth should be expected after an initial slow recovery from the recession. In the evaluation process, the overall performance of the industry in which ITS operates must be analyzed as well. Knowing the main components and characteristics of the industry is essential in order to provide a well-structured and sound recommendation. The staffing industry is characterized by assisting clients in the recruiting process, providing access to temporary and/or full-time employees, and providing employee data for its clients. 2011 metrics show that total revenue was $13.9 billion, total profit was $361.8 million, annual growth of the industry between 2006 and 2011 was negative 0.5%, and then expected annual growth between 2011 and 2016 is expected to be 4.7%. Total wages were $10 billion, and the total number of businesses was 65,000. It is important to know who the main suppliers of the industry are. Like any other business, staffing firms rely vertically and horizontally with other companies in order to provide a better service for consumer. The staffing industry main suppliers are computer stores, office supply stores, commercial and leasing firms, and IT consultants. The staffing industry main services are permanent and temporary placement services, which represent at 58.2% of the total revenue, and product-specific placement services, which represent 32% of total revenue approximately. To finalize our industry report, we chose to share with you the expected future performance of the staffing industry. The staffing industry is expected to increase the use of technology. Globalization is expected to play a larger role in the industry. And then competition is expected to remain high, and overall revenue is expected to increase.
All right, we're going to take a look at some financial statements for the company, which will help illustrate how we got to some of our numbers in the valuation. Looking at the income statement for 2011, that's the last year we have actual data for. The revenue was $203.3 million. Which is a year-over-year increase of 26.1% and a 3-year compound annual growth rate of 17.4%. The earnings before interest, tax, depreciation, and amortization from previous year was 38.6 and a 3-year compound annual growth rate on the EBITDA of 38.3%. Looking at the balance sheet, we can glean the current ratio is 6.56, which tells us that they're able to pay their current liabilities with their current assets 6 times over. Very healthy. Cash conversion cycle, that means they're turning their sales into revenue within 63.83 days on average. Very healthy as well, as about a little over 2 months. Receivables turnover, very healthy as well, 4.71. That's a very quick turnaround for credit accounts. Long-term debt as a percentage of total debt is 3.61, which is very small, to be expected with a services type company. Short-term debt to total debt is 96.4%, the majority of their debt. Looking at that as well, total liabilities over total assets gives us a number of 0.15, which tells us that their debt is largely being financed by equity. So moving along to the balance sheet, looking at current assets. When I'm giving these figures, they're referring to 2009 through 2011 fiscal year, because that's the hard data that we have. You'll see that on the left. On the right side, this is our projected information from that point on, 2012 through 2016. Cash and cash equivalents increased from 8.7 million to 14.6 million and is now 26.4% of total assets. Accounts receivable net increased from 23.1 million to 34.2 million and now accounts for 62% of total assets. And other current assets increased from 400,000 to 3.7 million, now accounting for 6.7% of total assets. And you can see accounts receivable, cash and cash equivalents, and other current assets here. Now, looking at total assets, those are added on top. Net fixed assets increased from 1.6 million to 2.3 million, now accounting for 4% of total assets. Other assets increased from 500,000 to 600,000, or 1.1% of total assets. And the company's total assets increased from 34.2 to 55.4 million as of fiscal year 2011. And you can see that increase here and continuing to increase into the future. Taking a look at current liabilities, those have increased from 6.5 million to 8 million, now accounting for 14.4% of total liabilities and shareholders' equity. Accrued payroll was the largest portion of this on average over time. This accounted for 4.3 million as of fiscal year 2011, or 7.8% of total liabilities and shareholders' equity. Coming in second was accounts payable, totaling 3 million and equaling 5.4% of total liabilities and shareholders' equity. Lastly, if we're looking at long-term liabilities as well, we're looking at total liabilities. Long-term increased from 200,000 to 300,000, accounting for 0.54% of total liabilities and shareholders' equity. Now, adding in shareholders' equity, on the bottom here, we can see that it increased from 27.5 million to 47.1 million and accounts for 85% of total liabilities and shareholders' equity in current state.
So now to get into how we got the final number for our non-marketable controlling ownership equity value, or the equity value, we used the three approaches of discounted cash flow, guideline merged and acquired company method, and the guideline publicly traded company method. And we used a weighted approach here where we put a lot of weight on the discounted cash flow method. In my opinion, it's always one of the more appropriate approaches to truly valuing a company. So we gave it 70% weighting, whereas we gave the other two 15% each. And so if we look here, like I said in the earlier section about the DCF, we got an indicated value of about $336,585,000. And if you look over here, we also, to give a good perspective of the value of the company, we also gave low and high estimates for each of the approaches. And so looking back at the DCF model, and you look at the sensitivity analysis, we use the low as kind of an estimation. If someone had an opinion of the weighted average cost of capital and the EBITDA multiple that didn't align with ours, then they could easily come back to the sensitivity analysis and come with their own opinions of what the enterprise value should be using this method. And so we use the low because we didn't want to get too outrageous with the assumptions, but we used the low as using an 8.5 multiple and a 16% weighted average cost of capital, whereas we used a 9.5 multiple and a 14% weighted average cost of capital for our high. And as you'll see, that gave us a pretty good range of about 53 million in between, and so 336 sits pretty nice in the middle there, and we felt that that was an appropriate number. So for the guideline merged and acquired company method, we found it to be at about 348 million, with a low of 308 and a high of 386. And then underneath that, we found the indicated value of the guideline publicly traded company method to be at 336,195,000, whereas the lows were 330 million and the high was 339. And seeing that our guideline publicly traded company method and discounted cash flow method were so close, it gave us a good bit of confidence in our estimates here that, you know, we had very good assumptions in all three of our approaches. So after multiplying the indicated values for each approach by the relative weight, we came to an indicated enterprise value overall of about 338,238,000. And so that kind of brings us in next to what Nick talked about earlier, and that's discounting for a relative lack of marketability. Given that it's a private company, we read up a good bit about this and feel like it's a pretty standard approach, and decided on the discount of about 7% of our enterprise value, which was about 23.676 million, which brought down our equity, our non-marketable controlling ownership equity value to 314,562,153, which we then rounded off to 314,600,000. And so this is what we found for our equity value essentially, and that left us over here on the right, as you can see, low and high estimates obviously to give in good perspective of 287.8 million and 334.3 million. So we threw that right about in the middle with 314.6, and you know, earlier in the guide it said that David had went to a banker and said that the company was worth at least 300 million. So this puts us right along with guidance from other banks. So we feel very confident about our estimates here. And it brought us out to a enterprise value over EBITDA of 8.76 and an enterprise value over revenue of about 1.66, which for a company in this stage of growth is pretty in line as well.
Hello again, my name is Nick Masters, and I'll be going over the valuation analysis. Specifically, I'll be going over the market approach, considering the guideline publicly traded company method and the guideline merged and acquired method. For each of these methods, we used the data given to us by management, including a list of 11 transactions that are comparable to ITStaffing, and a list of 11 comparable companies. So beginning with the companies, we decided to eliminate 3 of these companies based on one being an outlier, which is Attico. Due to its high EBITDA, its high market cap, and its high revenue, we eliminated this comparable. Next, we eliminated Robert Walters PLC due to geographical reasons. Most of its business is derived internationally, and ITS is a domestic firm, therefore we deemed it not comparable. Next, we eliminated Randstad Holding due to not a comparable line of business. Their business has to do with human resource services, where we are an IT staffing firm. So, we removed Randstad from the comparable list for the guideline publicly traded company method. Next, for the transactions, we decided to eliminate only 2 transactions on the basis of 2 being outliers to the rest of the data set. We eliminated transaction 3 and transaction 8 due to transaction 3 has a very high enterprise value of $1,157,000,000 compared to our enterprise value of an estimated $314 million. As for transaction 8, is also an outlier at $1,824,000,000. Now that we have eliminated the proper comparables, we can go on to the analysis of our refined data set. For the guideline publicly traded company method, we considered enterprise value to earnings before interest and taxes based on a projected 2-year basis and a projected 1-year basis and latest 12 months. We compiled the comparable companies and we did a statistical analysis consisting of low, high, first quartile, third quartile, mean, and median. We selected a multiple around the first quartile to come at indicated values based off a horizon percentage. So we weighted the projected year 2 by 20%, projected year 1 by 30%, and latest 12 months by 50%. So for enterprise value to earnings before interest and taxes as a whole, we gave that an emphasis of 20%. As for the other 80%, we used enterprise value to earnings before interest, taxes, depreciation, and amortization. We also used a projected year 2, projected year 1, and latest 12 months data from the comparable companies based off of a statistical analysis of the low, high, first quartile, third quartile, mean, median, and a selected multiple based around the first quartile. We also applied the same horizon percentages to enterprise value to earnings before interest, taxes, depreciation, and amortization as we did to enterprise value to earnings before interest and taxes. So we came to a multiple of 80% for the enterprise value to earnings before interest, taxes, depreciation, and amortization. So our indicated value of invested capital based on the guideline publicly traded company method is $336,195,000. For the guideline merged and acquired method, we considered the transaction enterprise value, target revenue, target EBITDA, and enterprise value to EBITDA. We chose to base our indicated value of invested capital on the harmonic mean of the enterprise value to EBITDA of the data. The harmonic mean is calculated at 9.02, and our subject company EBITDA, earnings before interest, taxes, depreciation, and amortization, is $38,600,000. When we multiply that figure by the harmonic mean derived from the transaction data of 9.02, we arrive at a market value of invested capital of $347,998,000.
Hello, this is Grant Schuette here again. Going to talk to you a little bit about how we performed our discounted cash flow analysis. So as you'll see here, our first step in the discounted cash flow analysis is to get a good projection timeline and project our income statement out to it. And we decided that projecting out to 2016 would be the most appropriate and give us a good 5-year projection. Now, unfortunately, the management only gave us projections out to 2015, and so we kind of on our own made an estimate for the figures for 2016. So if you'll see on the top line revenue growth from 2011 to 2016, you see growth rates of 16%, 10.2%, 8%, and 6.6% respectively. And so kind of to go in line with that decaying revenue growth percentage, we ended up using a pretty conservative figure in our opinion of 5% growth rate between 2015 and 2016 for the revenue figure. And we thought that was quite conservative considering their rebound from from the financial crisis in 2009, they had about a 3.9% growth rate. So considering their environment, considering the economic factors at play there, we feel like 5% is easily obtainable in 2016. And so if you look down at the expenses related on the income statement, you see direct materials, which is, direct costs, sitting at around 63.5%, 63.7%, sitting around 64% generally between 2011 and 2016 or 2015. So we tried to stay pretty close to that and get an average of that in order to come to our figure of $203,230,000 for our direct costs. And we repeated that process really for a lot of our expense lines on the income statement, kind of following that line of taking the expenses in the previous years and the projections that they gave us, finding a average percentage of that expense line to the overall revenue, and then projecting that forward to the next year and keeping just about the same cost structure. And so after all this, we found ourselves, and using a tax rate of 40%, of course, we found our net income to be in 2016 $32,150,000, which after adding back the interest expense, depreciation, amortization, and taxes, we found an EBITDA in 2016 of $54,810,000. And briefly, I'd like to also go over the balance sheet. So the balance sheet that was provided didn't have any projections out to 2016, but as you'll see later, we needed to use those for the net working capital calculations in order to find the variations in that over each year. And so what we did basically is we took all of the assets and we basically calculated them as percentages of the revenue. And we found, for instance, cash and cash equivalents to be about, on average for the years given, about 24.6% of our revenue. And so we just kind of kept that in line with the revenue and had cash be 24.6% of it, and we kept that pretty consistent throughout our projections. And then for shareholders' equity at the end, we basically just did our assets minus our liabilities in order to balance the balance sheet. And so we find that, we have shareholders' equity of about $51.5 million up into $68.5 million in between 2012 and 2016 respectively. So to calculate the weighted average cost of capital, which is our next step in the DCF analysis, in my mind, the first step in calculating that is to calculate the cost of equity. And in our model, we used a combination of the build-up model and the capital asset pricing model. And so the build-up model is the sum of the risk-free rate, the long-term equity risk premium, the size risk premium, and the industry risk premium. And so our risk-free rate was the 20-year Treasury bond as of December 31st, 2011. The long-term equity risk premium was found in the 2012 Valuation Handbook, Guide to Cost of Capital. And the size risk premium and the industry risk premium were found in the Morningstar Ibbotson 2012 Valuation Yearbook. And so after summing these values together, we got a 16% indicated cost of equity for the build-up model, which was then given a 50% weight. Now looking down here at the capital asset pricing model, which includes the other 50% of the weight, we have the same 2.6 for the risk-free rate and 6.1% for the long-term equity risk premium. And here we use an industry beta of 1.53. And if you look here, we took the levered beta from the comparables that were given to us, and as well as their equity, their capital structures, and we found a target capital structure of 10% debt and 90% equity for ITS, which is pretty appropriate given that they have 97.5% equity and 2.5% debt in 2011. And so given these levered betas, we re-levered it to the comparables by using a formula where we took the levered beta and we taxed it. We took the levered beta and we divided it by 1 plus 1 minus the tax rate times the percentage of debt in the total capital structure over the total equity in the total capital structure for the specific company. Then we multiplied that also in the denominator by 1 plus 1 minus the tax rate times the debt, the percentage of debt in the target capital structure over the percentage of equity in the target capital structure for ITS. And that gave us the levered betas that you'll see, re-levered betas you'll see here, and we found the median of that to be 1.53. And so after finding that 1.53 for the industry beta, we find the beta adjusted equity risk premium to be 9.4%, which was then added with the size risk premium and the risk-free rate to be 15.9%. Putting these two together, which are very close, gives us a high 15.9%. So now that we've calculated the cost of equity, we can get on to calculating the total weighted average cost of capital. And so we found the cost of debt through the comparables, where we found just the median of the comparables cost of debt. And then once taxing it by the 40% tax rate that we assume, it comes out to about 2.3%. So now to calculate the weighted average cost of capital, we took the cost of the tax deducted cost of debt and multiplied it by the debt in the capital structure, and then we added that to the cost of equity times the equity in the capital structure, and that gave us to 14.6%. And now onto the net working capital calculations. Pretty straightforward, just the total current assets minus the cash, minus the current liabilities subtracted by the current interest-bearing debt. This gave us an increasing net working capital, so we're going to have subtractions later on to our free cash flow, because when accounts receivable goes up, for instance, it's not actually a cash flow inward, it's actually just an overstatement of sales, so we have to make an adjustment for those earnings. So now on to the actual DCF model. So what we're doing here for the next step is to take our projections and find the free cash flows for each year and discount that to a present value. So we start off with the projected EBITDA, subtract the depreciation amortization, get to earnings before interest and tax, deduct the taxes, and then we have the debt-free net income. So after this, we add back depreciation amortization because it's not actually a cash flow. Subtract the capital expenditures because that is the actual cash flow from the fixed assets that would be depreciated. And then we add or subtract the changes in net working capital. And this will give us our free cash flow, which we then multiply by the present value factor, which is given by 1 over the weighted average cost of, or 1 over 1 plus the weighted average cost of capital. And then for the second year, it'd be 1 over 1 plus 1 over 1 plus the weighted average cost of capital to the second power. And then for the next year, it's 1 over 1 plus the weighted average cost of capital the third year, and so on and so forth. And so this gives us our present value of the free cash flows for each year, which we then sum to find 86.4 million. And so after finding that, we needed to find the present value of the terminal year, which we used an exit EBITDA pricing multiple of 9.02 to multiply with our terminal year's projected EBITDA of 54.8 million to get about 500 million. And so once again, we use the weighted average cost of capital to discount this to a present value using the same present value factor as in 2016, or for the fifth year, which is about 0.5. And that gets us to the present value of our terminal year of 250.158 million. So after finding this present value of the terminal value, we added that with the present value of all our free cash flows for the projections, and summed that to find the indicated enterprise value of $336,586,000 for our DCF analysis. And if you look over here to the right, we have a sensitivity table because oftentimes when you're calculating a DCF, you can use different assumptions like the EBITDA multiple and the weighted average cost of capital. You can use different underlying assumptions that'll give you different numbers or different values for your enterprise value. So we kind of showed what those numbers look like given different EBITDA multiples mixed with different weighted average cost of capitals, and felt like that would give whoever was looking at this a greater perspective of what is the actual value of ITS. So in summation, we found Staffco's offer to be the most attractive. They offer a cash and stock mix that totals to $360 million, with $220 million of that being in cash and $140 million of that attributing to 5.671 million in shares. So we found this more attractive than the HGE offer because the HGE offer offers $95 million for 40% of our equity, whereas we found 40% of our equity to be worth about $125 million. So this serves at around a 24-25% discount to what we found as the fair market value. Now, with the $360 million consideration, we found that to be about a 14.4% premium to what we found as a fair market value. And what we recommend for management is to kind of push back on the negotiation and say up the cash consideration to about $240 million, and that we could find some way around in the middle, about 230, and try to squeeze an extra penny or two. As for the consideration to continue with the business as usual and take the dividends, we find that it's kind of a risky business being in such a small private business to say that 10 to $12 million in dividends being brought in each year could bring you the same amount of value as selling today and getting instantly $220 million in cash. In summation, Staffco's offer would provide a better opportunity for ITS in general because they want to use ITS as a competitive advantage and will most likely treat the employees very well as the managers they stay on. However, with HGE and a private equity LBO, their main target is to get in and get out usually within a 5 to 7 year projection period and get a good return on their investment, which may not always lead to a good business relationship and a good outcome for ITS as an origination. And given that Andy, Eduardo, and David had started this off from the beginning, I'm sure that they want to see it through to the end, that ITS has a good transformation over the years and continues to succeed.
On behalf of the group, it's been an honor to do this valuation for you, and we hope you'll consider our recommendation. Thank you.